All right, what's going on, guys? Hey, let me know real quick in the live chat that you can hear me. Sorry, I was just bebopping on my computer over here for a second. Wasn't really paying attention, so let me let me make sure everything's set up right. Let me know if you guys can hear me real quick, but hopefully you can. Welcome back. Okay, Adon says you can hear me. Good. Welcome back to another Dividend Happy Hour, episode 109. My friends, happy Friday. I hope you guys all had a fantastic week. I am so stoked to be back here with you tonight for another live stream. And this is the first time trying something new today too. This is the first time we're actually probably not a big deal to you guys, but it's kind of cool to me. This is the first time that we're streaming in 1080p. Hopefully it's crisp. Hopefully it's not glitchy or anything like that. But anyway, kind of cool. Usually I only stream in 720 pixels. Like I said, nothing super cool, but anyway, interesting to see how it turns out. So guys, where do we go from here? I mean, interesting week on the stock market. I think my portfolio ended up down a little bit for the week. I'm down. I mean, these last few days have been pretty rough, but we're hanging in there. I don't know. Before I go off on any tangents, why don't we kick this thing off the best way we know how? Grab whatever it is you're sipping on, my friends. Let's do a quick cheers. So here's to you guys. Thanks for tuning in with me tonight and hanging out for this next hour and joining another Dividend Happy Hour. So here's to you guys for that. And also here's to the dividends. Here's to the pursuit of that sweet, sweet cash flow, which is really what's bringing us together tonight. But anyway, here's to you guys. Cheers. Let me know a few things here in the live chat. Number one, I want to know, which stocks did you buy this week? What did you add to your portfolio? I feel like it's getting to be, I think I said this last week, but I feel like it's getting to be kind of slim pickings out there. So I'd be curious to see what you guys are buying and what you're adding to your portfolio right now. So let me know that, number one. Number two, I want to know, what are you sipping on tonight? What did you bring to drink to the Dividend Happy Hour? I don't have anything exciting. It's some sparkling water concoction that my wife made me. It's really good. It's, I don't know. I think it's just some of the flavored, I don't know. She'll have to correct me, but I think it's some of the flavored sparkling water from Walmart with some additional flavoring in it. But anyway, really delicious. But yeah, let me know what you guys are sipping on. And number three, I want to know if anything cool happened in your guys' portfolio this week. Did you hit any cool milestones? Like maybe you bought your 100th share of SCHD. Maybe you hit $1,200 of annual dividend income. Maybe you're on track to have your highest income month yet. I don't know. Anything cool that happened to you guys this week, let me know in the chat. I'd love to throw some of your accomplishments up here on the screen. So let me go through real quick. I'm going to scroll back up all the way to the very tippy top and see who we got in the building. See who's here tonight in the Dividend Happy Hour. So first and foremost, I see my man, Matt B. Glad to see you again. Happy Friday. I see Trista here. Good to see you, Trista. Andrew's in the building. We got Run DMS here. Of course, we've got Shamir. Where else would Shamir be on a Friday night? That guy NLP, what's going on? Jim Betts in the building. Big bad Jim Betts, as we like to call him. Pat's here. Good to see you, Pat. Did I already say what's up to Adon? I think I did. Maybe I didn't. I think I did. Maybe I didn't. I don't remember. Adon, what's going on? Phillips here. Good to see you, my friend. We got Kama. We got TF. Fast Eddie's here. Good to see you, Eddie. Marcus. Let's see what else. Oh, wow. This is quite the pickup from Kama. 15 shares of Broadcom. Nice. Very nice. Let's see. Janice is here. Good to see you, Janice. This is cool. New dividend high this month for me. $720 for Janice in September. That's crazy. $720 without having to lift a finger. Love it. Good job, Janice. Who else we got? Luis is here. Finally back. Yeah, Luis, I was thinking about you recently, man. I think you recently had a big birthday from what I saw on Instagram. So happy belated, if that's what it was. Happy belated birthday. And yeah, man, it's been a while since I feel like I've seen you in the chat. So happy to see you here tonight, and I hope you're doing well. We got Pedro here representing Rhode Island in the house. Good to see you, Pedro. Thanks for tuning in. We've got Roxanne from the DFW. Is that Dallas Fort Worth? I think, right? So anyway, welcome aboard. Happy to have you here. Shannon's here. Marcus is here. CA's. Fat Zeus Gaming, actually, excuse me, says first live stream. Usually watch the replay Saturday morning, but working on the race car and watching. Nice. And that reminds me, if this is any of your guys's, or rather for any of you guys, if this is your first time tuning into the Dividend Happy Hour, let me know here in the chat. I'm curious to see how many first timers we've got. And just so you know, we typically do this stream every Friday night starting at 5 p.m. Pacific time. So if this is your first time, I hope you enjoy it, and I hope to see you back next week and all of the weeks after that. It's pretty cool. We have our usual suspects here, and this is a very fun weekly ritual, and I'm glad that we get to do it. But yeah, for all you first timers, we do this every Friday night starting at 5 p.m. Pacific time, 8 p.m. Eastern time, and we'll usually run it for about an hour or so. Anyway, we got Sir Dudebro Man in the building. What's up? What's going on, man? Sean's here from Australia. Good to see you, mate. Sorry, forgive me. Andrew's here. Good to see you, Andrew. Run DMS is liking the Bad Brain shirt. Yep, gotta love it. Let's see. Yeah, down overall. You guys talking about some of your portfolios? I get you. Paul's here. Good to see you, Paul. Paul Triplet. Charles is here on his way home. Let's see. Interesting. Okay. So Matt had a pretty interesting week. So sipping on a Simply Spiked lemonade. Nice. Sold out of EPD and ExxonMobil. Interesting. And reallocated to Realty Income and a ton of Chevron. Yeah, Chevron saw a decent drop today. Yeah, they're definitely getting down there. Also picked up some Visa, Williams-Sonoma, Pepsi, Lowe's, and my 65th SCHD share. Good job. Good job. And just so you guys know, too, I actually didn't buy anything this week. I bought, my usual dollar cost average into SCHD and VU. But other than that, I actually didn't buy anything in the taxable. Still put my weekly contributions in there. Got a little dividend income this week. I think my only payment was from Visa, actually. Excuse me. But yeah, I did not put that to work. So we'll see what next week brings. Chevron's looking pretty good. That's really Chevron and Visa are kind of like the only two that I have my eye on. Actually, there's one stock on my watch list that had a terrible week this week. That after its performance, I really, really have my eye on. It's looking like a really good opportunity. So, and I'm going to be talking more about that in Sunday's video, but I could be starting a new position here pretty soon. We'll see what happens. I'll tell you guys more about that in the Sunday video. But anyway, let's see. Owen's here. I'd buy more Chevron if I had available funds. There you go. Yeah, Janice is stacking some cash as well. Jim, few good pickups from Jim here. Bought and buying. Vici, agree. C&Q, nice. And got the coffee brewing. Good stuff. Good stuff. Mindy, good to see you, Mindy. Picked up some Chevron this week. Good stuff. Let's see who else we got here. This is cool. Mark is almost to an Alvaro. What's going on? Sorry, I skipped over you. But Marcus picked up his 99th Visa share, or Vici. I'm all over the place, guys. 99th Vici share this week. That's cool. Almost to that 100. So, man, next week you'll have to cross the finish line and get there. Yeah, I see a lot of Chevron pickups this week. CA's picked up some Chevron as well. Let's see. I see some more Visa. Let's see. There we go. Luis, fixed ETF combo, SCHD, VTI, VEA, and VYMI plus some T-Row. Nice. Drinking Old Par Scotch. Nice. Look at that portfolio value too. $208,000. So, Luis, you'll have to remind me. You might remember. I don't off the top of my head, but in either the first or second portfolio review video, guys, that we did over on the channel, we reviewed Luis's portfolio, and at the time, I thought you maybe had, it was in the hundreds. It was maybe like, I want to say between 150 and 170K. I could have that wrong. But man, you've been making some really great strides in your portfolio since then, in the last couple or few months, really, huh? So good job, man. Officially across the 200K mark. That's very impressive. You're crushing it. There we go, Sir Dude Bro Man. I'm sipping on some Visa, and I invested a little bit into some nice agua. There you go. I get you. Good stuff. Sounds delicious. Sipping on a little Visa. There we go. Yeah, Janice, 2 weeks ago, single share of Chevron. A week ago, Visa. This week, 3 shares of IDUS. Nice. Yeah, Chevron looks like a pretty popular one. We got Matt G just jumped on, listening from the gym and drinking water. Nice, Matt. What are you hitting tonight? Let us know. Let us know what's going on. I did legs today. Going to be sore tomorrow. My tris are actually, I did arms yesterday. My triceps are actually pretty sore today. I did, for the first time in a while, I did some dumbbell skull crushers, and that's what did me in. I don't always feel those, but yesterday it was feeling really good. Let's see, keep going here. Yeah, I see some Hormel from Ted. Picked up some Hormel. Interesting. Nice. Oh yeah, the Luis turned big 40. There you go. Cool, man. Well, happy belated birthday. 40 is a big one. All right. Let's see. Oh, there we go from Lance. $70 worth of Snap-on. Nice. Yeah, Snap-on. I mean, what's the price at for Snap-on right now? Let's jump over. Where is it at? Snap-on's at 270 a share right now. So I think it's seen a little bit of a pullback this week, right? I thought it was recently in the 280s. Let's see. Let's keep going here. Yeah, I see some more first timers. Nice. 1, 2. Looks like there's about 4 or 5 first timers tonight. Well, guy, that's awesome. I love it when we get first timers here in the live stream. And once again, I hope you guys enjoy it. It's kind of just I mean, as you can tell, there's no direction with this. There's no plan. And I think that's the fun of it. We just kind of hop on and just shoot the breeze for an hour and see where it goes. And every week it's different. At some point, though, someone's going to bring up something yield max related. That's usually a given. But yeah, it's always fun just kind of having these random times and just seeing what you guys have to say. Let's see. The Dividend Pro. Good to see you, my friend. Ooh, good guess, Kama. Good guess. He guesses Old Dominion for my Sunday stock. No, it's not Old Dominion. Although they did. Let's actually just jump over here. They actually did have a what did Rollins do today? Okay. Rollins has been really hovering around this $50 per share mark. I get excited when I see days like this where it drops 1.5% almost during the day. And I'd love to see like a good month straight of just this right here from Rollins. I don't think we'll get it, but anyway. But yeah, what did you said Old Dominion, right? So who had a really good week is Casey General Store. They were up 6% for the week. What did Old Dominion do? They were down 3%. Yeah, it's not bad. Not bad. So anyway, I bet just by looking at this, you guys can probably guess. I probably just spoiled it, but that's okay. Which stock we'll be talking about Sunday. Yeah, Marcos got it. There you go. Zach says, what do you think about Waste Management? I think Waste Management's a solid company. I actually have one of its peers, RSG, Republic Services Group, here on my watch list. But yeah, in general, I would say that Waste Management or that type of business is a pretty safe investment. I really can't think of what could come in and disrupt that industry. So I think those type of companies, whether it's Waste Management or Republic, anything like that's pretty safe hold. But the thing is, they're always because they are so safe and such high quality businesses, they are typically on the pricier end. Like if we go to RSG, I should be doing this on Snapstock, but we're over here on Seeking Alpha. I mean, over the last year, it's up 41%. Last 5 years, 130% almost. So yeah, it's not too many dips in here either, right? So maybe slightly here and there, but I guess, not too long ago, this really wasn't too long ago, January 2023. October, almost a year ago, it was below 150. So that's not bad. Yeah, I like these companies a lot. I'd love to add Old Dominion at some point, though. So you guys still talking about that? So let's see. Bunny here says this is kind of an interesting question. So why is dividend investing your preferred strategy? Stocks go down the amount of dividend declared, and dividends are short-term capital gains compared to capital appreciation from non-dividend stocks. So that part's not entirely true. Um, dividends, especially qualified dividends, are actually taxed at the same rate as capital gains. They're taxed at the long-term capital gains rate if you get those qualified dividends. Now, ordinary dividends from things like REITs and business development companies, you could be taxed a bit more, but it just depends. Like, it really depends on your overall tax situation, which bracket you fall into, and there's a myriad of variables that can determine that. Your income, your write-offs, deductions, whatever. So there's kind of a lot more that goes into it. But to answer the question, why is dividend investing your preferred strategy? There's a few things that I really like about dividend investing. I mean, first and foremost, to me, it's an extremely straightforward way to invest. You buy the assets, you hold on to the assets and continue to accumulate them. They pay you cash flow, they pay you income, kind of like you receive for working at your job. You reinvest that income. That income then pays you more income. And over time, if you just repeat that process, eventually you'll get to a point to where that income is paying your bills and you don't need your job anymore, or at the very least, you don't need it as much, and you can kind of slowly scale back if you want to. Anyway, or it just gives you optionality. You know what I'm saying? So I really appreciate that aspect about it. And along with that comes, it creates a situation where down the road, you don't have to sell out of the assets and dwindle down your portfolio and start selling off these assets that you just spent the last however many decades accumulating. So I really like that aspect to it too. It doesn't really sit well with me to have to, work so hard and actually sacrifice so much money today to down the road, then just start liquidating all of that in order to pay your bills. That just doesn't really compute for me. I don't know. It's just, like I said, dividend investing is so much more straightforward. It's so much more straightforward to me to just create or generate that income and use that and be able to hold on to those shares. And I think you're making I don't know if there's an assumption or something in here talking about stocks go down the amount of dividend declared. That doesn't really bother me. And I've actually done really well. If we look at, if we go back over to my spreadsheet, still even with that, even if the share price declines slightly on the ex dividend date by the amount that the dividend will be paid, it still all works out in the end. I've still, if we look at the share price returns, I've done pretty well with a lot of the companies in my portfolio. 96% with Williams-Sonoma, 70% with AbbVie, a handful of other companies still up 20-30%. And so I don't really mind, like, if I was to receive a higher share price return, if the dividend wouldn't have been paid out, that just doesn't really, I just don't really care about that all too much. It all works out too. And if at the end of the day, total return is all that matters, then it really does all even out, because then the amount that you were paid from the dividend just gets added into your total return. And that's why we look at this metric and not just share price returns, because it takes in the dividends into account. So, and I've done even better looking at these share price returns than I have, or the total returns than I have with the share price returns. So, yeah, I don't really get why a lot of people freak out and make it a whole thing when the share price goes down from the dividend payment. But there's all sorts of things that can impact share prices. You could have an ex-dividend date and still see a stock that's up for the day. So it's just not, I don't know. I don't know if one should use that as an argument against dividend investing. It's just kind of a non-issue in my opinion. But really good question. There's a lot of other things I like about dividend investing too, but I would say that the main thing is just the idea of generating that passive income and not having to sell your shares. I think this is more akin to actual business ownership than is buying stocks that don't pay a dividend. And I think, when you get to the root of really what the stock market is, it's a vehicle, it's a market for owning businesses. And I don't think it's unreasonable to expect that the businesses that you own pay you a distribution, pay you a percentage of their profits. I actually think that more people should expect that. And that should be a requisite for more people than it is. And I think if you were buying a piece of real estate, or if you were buying a private business, like if you were to open up a restaurant or a bar or a laundromat or have vending machines or you name it. You know what I mean? I think that there would be that expectation. And I don't know if, I'm not sure why publicly traded companies should be looked at any different. That's just my personal take. And, people do just fine investing in non-dividend paying stocks too. But my personal preference is to buy things and have them pay me a dividend and have a sort of cash-based relationship, at least in part with the businesses that I own. So Dividend Pro, this is nice. You do a great job. Thank you. Chevron, Pepsi, and Home Depot. Goodbyes this week. Goodbyes. I appreciate the kind words. So good. Let's see, guys. What else? There we go. Salvatore. Almost at 50K in the dividend portfolio and 40K in the growth trading portfolio. Very nice. So total, Salvatore, you're almost at that 100K mark. That's incredible, man. Good job. Very good job. I also want to shout out Adam Kong. Good to see you, my friend. Hope you're doing well. And Junior, sorry, Junior, I didn't give you a shout out, but good to see you. Tony's here as well. What's up, Tony? Let's see. Oh, there we go, Casey. Wish I could stay for the live. It's Harry Potter marathon. It's getting to be that time of year. I get you. All right, so let's keep going here. I see Brent. Let's see. Oh, Tony, when are you going to start investing in real estate? I actually already do invest in real estate. I've actually literally right before I went live, I was dealing with some real estate stuff. So at the moment, we have 2 properties, one of which we just bought a couple months ago. It's going to be a fix and flip. So we just started the rehab on that this week, actually yesterday. Another one is the other property is a vacant lot that we've had for the last couple of years in my hometown. And that one we actually bought at an online auction. And unknowingly, when we bought it, it was going through this contamination case. It used to be like a gas station. And so under it, there were storage tanks and stuff for the fuel and whatnot. And so with that, there was some sort of soil contamination that we've been dealing with these last couple of years. And just now that's been getting resolved. And so actually the case is officially closed as of this last month, but that was a whole to do. And so now we're in the process of actually selling that lot. So that's an escrow right now. And that's going to look really good. And also on top of that, so we had to pay for the cost to basically have a geology company come out, and there were some groundwater wells that they were using to sample the soil just to monitor the contamination. And so we had to basically pay for the geology company to come out, run an analysis on what they see in the wells, determine that there's no threat for further contamination. They did a whole to-do, had to destroy the groundwater monitoring wells, submitted that to like the state water board. And like I said, that case was just now closed. So awesome. It's awesome. That was a lot of hard work these last couple of years getting through that process. Really, really good learning experience. And that's actually going to turn out to be a really, really solid deal. So we're going to do pretty well with that one. The fix and flip house that I was talking about, we'll see how it goes with that one. There were some unexpected surprises with that one as well. But once again, another learning experience. I think we'll come out a little bit ahead, but yeah, I'll just leave it there. Anyway. But yeah, I do some real estate stuff. I'm not as active with it as I am with stocks, obviously, but the real estate deals are a bit fewer and farther between. But there's a little something going on there right now. It's more active now than it has been these last couple of years, really. So let's see. Oh yeah, Matt says leg day for me as well. Hoping I can actually walk out of here. About Chevron. Yeah, a lot of Chevron buys this week, guys. A lot of Chevron buys. Real quick, I see Jack Mack in the building. Sorry, guys, I'm about 10 minutes behind in the chat too. But Jack Mack is here. Anthony's here. Good to see you both. Good to see you both. Salvatore, when do you determine when you add to a dividend stock? Man, that's a tough call. So, I mean, right now, I'll just tell you kind of my thought process right now because I am considering starting a new position in one of my watch list stocks, like I said. And my thought process now is, I don't really see anything super exciting in my portfolio right now. Chevron, yeah. Visa, sure. Um, and so when I don't see anything that's interesting, super interesting in my portfolio, then I'm kind of look elsewhere. I mean, I'm always kind of keeping tabs on the watch list stocks and whatnot. And I'm looking at one of them right now, and it just, I guess, like I said earlier, it's seen a pretty big pullback in this last week, and it's at its 52-week low. And I think this is a very high quality company. Um, and so I'm kind of looking at it thinking, I think this could be a good opportunity to get in right now, or at least start dollar cost averaging and see what happens. It's down quite a bit. It could go lower. We'll see what happens. But I think dollar cost averaging into this particular one would not be a bad move you know, if I think this is a high quality company and it's one that I'd like to own, then now's not a bad time to get into it. So that's kind of my thought process so far. Hopefully that answers the question. It's really circumstantial. It really depends on the situation, but I would say the main catalyst that helps determine when I add to a certain stock is kind of the price action and what the share price has been doing. Like if I'm looking at a stock like like Starbucks recently, for a while I mean, I saw a very sudden and aggressive drop. It stayed there for a while. It was below my cost basis, so that one was kind of a no-brainer. But then, just as well, when it popped back up and is now sitting at $91 per share, it's like, okay, well, I got my fill of buying. It popped up now, and I probably will hit the pause button there. But switching gears, and I should probably pull this up on the screen, maybe easier to look at. Let me zoom in. Let me zoom in a little bit. Chevron, like I was saying, that's kind of the only interesting one in my portfolio right now. That one in Visa. Now, as far as my position goes, I'm still up, 23.5% looking at the share price return. Not bad. I think at one point, I was close to seeing a 100% return with Chevron. I might have even been over 100% at one point. I don't remember. But anyway, I'm looking at this thinking, it's still 23.6% above my cost basis, but at the same time, it's at its 52-week low. It's continuing to hit new lows right now. And so I'm kind of looking at this one thinking this might not be a bad one to dollar cost average into either. I mean, my average cost is $112, but this is a business that I plan on owning for a long period of time. And so I don't want to get too anchored. I was actually talking with Russ about this yesterday. I would say like one of my biggest struggles as an investor is getting anchored to my average cost, my cost basis with positions. Like I look at this and think ideally I'd want to buy more of it when it gets below my average cost per share. But this has been a really nice average cost. And it wasn't too long ago that my average cost was actually below $100. But now where it's at 140, I'm like, it's still so far above where I'm at. But I think you need to work to overcome that, especially when it comes to stocks you plan to own for a long period of time. I think you need to take advantage of opportunities like when they hit their 52-week lows, because as time goes on, businesses intrinsically become worth more. So while this is a really good buying price at the time and is probably even better today, this might not be, because this business is still growing. This might not be a bad price to buy it at. So it's down quite a bit. So anyway, I'm kind of rambling at this point, but that's kind of the thought process with some of these stocks that can maybe help determine if I want to add to it or not. So. Oh, this is a tough one. I'm going to screenshot this because I think this would be a good question to answer in a Q&A or a newsletter. So good question, Christopher. Thank you. Let me save that. So what is your favorite dividend stock? It's really tough. Gosh, that's so tough. It's like, how do you pick a favorite child? You know what I mean? Although in my family, that's not too hard to do. Let's see. I've let me just narrow it down a bit. I would say the ones that I have probably the greatest affinity for would be probably Realty Income, and this is in no particular order yet. Realty Income, Procter and Gamble, Starbucks, Snap-on, Visa, Vici, Williams Sonoma, EPD, Johnson and Johnson. So I mean most of them, right? And there's things that I like about there's different things that I like about different companies. Johnson and Johnson and Procter and Gamble. I love the sleep well. I love the sleep well at night component to them. I just think they're such stalwarts. You know, I love the dividend growth rate from Snap-on and Williams Sonoma. I love that Williams Sonoma has no debt. You know, Vici or not Vici, excuse me. Well, yeah, Vici. You know, this one hits very close to home because it's you know a lot of its revenue is derived from Las Vegas. So this one is one that I have a huge affinity for. But also, it's double trouble in the dividend department. They've got a near 5% yield with a I think 7-ish% 5-year dividend growth CAGR. They just raised their dividend by another 4%. So anyway, you're looking at a nice yield and nice dividend growth. Visa, you know, I've called it the gold standard of dividend stocks or the gold standard of stocks. You know, it's got a really low starting yield, which is probably its biggest, well, maybe its only blemish. If I had to find one thing wrong with it, I wish it had a higher yield. It's at about 0.8. Really nice dividend growth rate, low payout ratios. Fundamentally, it just doesn't get any better than this company right here. And if I had to narrow it down to just one, if I absolutely had to, like, and if let me actually rephrase it this way. If I had to sell out of all my positions and just hold on to one, it'd be Visa. So I guess, yeah, probably Visa if I had to pick one, but it's tough. You know, like I said, it's tough. I like different things about these different companies overall, you know, zooming out, looking at things from a portfolio level, top down. I think I have a very solid mix of stocks here. And I think in terms of, you know, the sectors, in terms of the industries, in terms of the dividend stats, I think I have a very wide range of different companies. You know, I've got some of the high yielders with low growth. I've got low growth stocks with high dividend growth or low yield stocks with high dividend growth rates. And I've got the stalwarts, which kind of have like, you know, low growth, low dividend yield, but they offer that stability and that defensiveness. So I think there's room for that, certainly room for that in a well-balanced portfolio. Anyway, did I see Russ in here? I see you guys saying what's up to Russ. Yeah, there he is. Let's see. I lost my place here in the chat. Jack Murphy, what's going on? I totally lost my place here, guys. Where was I? Here we go. Okay, let me get caught up here in the chat. So I'm like 15 minutes behind right now. I want to zoom up a little bit. Let's see. And I apologize in advance if I skip over some of your guys' comments. I'm trying to just get caught up here in the chat. So if I skip over it, just drop it again in the chat if you wouldn't mind. Let's see. This is a good question. Going back to the real estate stuff, will you be sharing your renovation on your channel? Possibly. Unfortunately, I don't have any before pictures that I can show you, and it's in my hometown, so I can't really. It's kind of I'm kind of detached from it right now. But maybe we'll see. We shall see. Maybe when it's all behind us, I'll talk about. I can at least talk about it and the financials and stuff like that. We'll see, though. We shall see. And if I get pictures of the after, like after the rehab's done, then I could use that to put together in a video. I think it'd be fun. I don't know how much interest there would be across the entire channel, but it would be a fun thing to talk about. Oh, there we go. Kama has a small gym in his garage back day. There you go. Nice. Okay. Show your home flip remodel. Let's see here, guys. No, no love for MPW. No. Yeah, Russ. Favorite dividend stocks are fun but subjective. The only way to truly buy, hold, and sleep well at night is buying the entire market. Let's see. Visa seems to be the favorite of YouTube finance channels right now, but then again, so is 3M back in 2018. I mean, totally different though. I mean, totally different businesses. Let's see. Yeah, nice picture with PPC Ian. Thank you. Yeah, it was cool. I I was able to get together 2 days ago with the one and only PPC Ian. And it was fun. We met up at a Starbucks down on the strip. He was in town for some real estate conference. And yeah, we were able to sit and have coffee and chat for about an hour and a half, and it was a lot of fun. He's a really nice guy and is just like how he is in his videos. Very, very nice. And yeah, it was a really fun experience. Very full circle. Full circle. I can't talk. It was a very full circle experience for me too. You know, I told him this before I started making videos, and when I was first getting into investing. You know, his channel was probably one of the first ones that I really got into. Most definitely one of the first ones that I got into specifically related to dividend investing, or that specifically talked about dividend investing. And I mean, with that said, he's really, really inspired me from the start and has really taught me a lot. And yeah, I mean, Ian definitely has and Russ is the same way actually, because it was the same story. I was watching his videos before I started making mine, and started watching him when I was first getting into all this stuff. And so guys like that really put me on the path to this style of investing. And yeah, it's cool. I mean, in more ways than one, it's been life-changing. So I'm very, very thankful. And like I said, it was fun meeting Ian, and I look forward to doing it again, hanging out with him sometime, hopefully sooner than later. So this is a really good question. So why doesn't SEHD have any holdings in REITs? Just curious. So I believe the main reason for that is because if it contained REITs, it wouldn't be able to pay a qualified dividend, and SHD pays a qualified dividend. So I think that's one of the big reasons. I'm not sure of any others. Maybe there's no REITs in the index that it tracks, which is the Dow 100 dividend index or something along those lines. So that could be another reason as well. But I do think part of it certainly has to do with the tax implications of having REITs in the fund. So this is a good question. Trevon says, how many, I actually don't really know. How many shares do you consider to be a full position? Oh gosh. So, I mean, what even is a full position? You know, is a full position enough that you're done buying? You know, like you get to a certain number of shares and it's, you don't want to add any more because of its weighting in your portfolio. Is that a full position, or is it more permanent than that? You get to a full position and then you just never buy again. I would imagine it's probably the first one, to where you just get to a certain number of shares and you decide, okay, that's enough for now. It's already X% of the portfolio. I don't want it to be anymore. And with that said, I mean, to answer the question, I think however many shares just depends on the weighting in your portfolio. Like how, you know, what's your rule of thumb with that? I know, personally speaking, I try not to let any one position get to be, you know, maybe more than around 10% of the entire portfolio. And I've broken that rule a little bit. If we go over to the spreadsheet here, and by the way, guys, you can download and use this spreadsheet for free. There's a link to it in the description. I forgot to mention that earlier, but we can see that I've broken this rule in a couple of different places. So right now, Starbucks is 10.8% of the portfolio. Right now, Vici's, or I keep doing that. Right now, Visa is 10% of the entire portfolio. So both of these are kind of like at the maximum end of the threshold that I would want to see. So I probably would consider these full positions. But I will say, if Starbucks was still below, if Starbucks hadn't seen its crazy pop, I probably would still be buying it. And so I'd have to be okay with it becoming a larger weighting in the portfolio and maybe being more full of a position that I really want. Or then meets my, that exceeds my criteria, which is that 10% or around that 10%. But at the same time, I think you need to take advantage of buying opportunities when they present themselves. And I think this is a really good example of that, actually, because it wasn't, it was only a temporary period of time where it was a really good time to buy. So in those, when you have those opportunities, you kind of have to take maximum advantage of them. And temporarily that might push these positions to a point where they're larger than you'd like them to be. But once again, that's only a temporary thing. Like, for example, I remember there was a period of time, another example, actually, there was a period of time where realty income made up like, I don't know, maybe somewhere between 13 and 15% of the total portfolio. And it was an even larger percentage of the overall dividend income being generated in this portfolio. And the only reason it got so large was because it was such a good buying opportunity that it was like, you got to take advantage of it while you can. And, that ends up working out, or that ended up working out, excuse me, that I was able to lower my cost basis, establish an overall a bigger and better position. And it all worked out in the end. There came a point in time soon after that where I stopped buying realty income because it wasn't at the price I wanted anymore. And I bought other things. And upon doing so, it helped balance out my portfolio. And over time, the same will happen here with Starbucks. Right now it's 10.8% of the portfolio, but by buying other things over time, it will gradually become less and less. And the portfolio diversification and the balance across all of my holdings will kind of work themselves out. So hopefully I know that was a very roundabout way to answer your question, but hopefully it did it justice. That's how I think about all that stuff. So Salvatore says, "Do you do one-on-ones? I feel like I could learn a lot from you, and I wouldn't mind paying for it." I've never really considered that, but I don't know if there was enough interest out there, then I would consider offering that type of thing. But no, at the moment I don't. But you know what, Salvatore, you're always welcome to email me if you ever have, and any of you guys, you're always welcome to email me if you ever have any questions or just want to talk stocks. My email, I don't have it in the description, but it's just Ryan at retirewithryan.com. Hopefully that's easy enough to remember. Ryan at retirewithryan.com. So anyway, yeah, always feel free to shoot me an email if you have any questions or just want to talk shop. So Girl Max, thank you so much for your insights and help with stats. However, you don't mention your ETFs. Do you have any? Yeah, I do. I have 2 ETFs. I have SCHD and VU right here. This makes up my entire Roth IRA. And right now, guys, almost 90 shares of SCHD. We're getting that 100 by the end of the year for sure. No doubt about it. But yeah, SCHD and VU, I invest into both of these every single week and will continue to do so maybe until the end of time. I don't know. As long as I'm around, I have plans to continue doing that. Oh, this is a good question from Chris. Do you think PKG will have some correction at some point or at some stage? I don't know, but that's another one on my watch list. I really don't know. I can't predict that, but I like that company a lot. Really, really good company. Really boring company, but a good one. Roland, will you be making any moves with possible upcoming rate cuts? No, I mean, I don't really. That doesn't really impact what I'm doing on a week to week basis. Nah, not really. No specific moves as a result of upcoming rate cuts. Okay. Yeah. So Derek, this is an interesting question. Hi, my PTF, what's PTF? Has currently only individual stocks. Would the snowball work if I reinvest dividends in a dividend ETF? Yeah, 100%. Really, that would totally work. But really, the dividend snowball, I'll kind of lay it out to you like this. It's the dividend snowball basically just describes the process by which your passive income grows over time. And there's three different ways that the dividend snowball can grow. The first of which is by you feeding into your portfolio, you making contributions to your account every single week and every single month, then using that money to go and buy stocks. That's one way that your dividend snowball will grow. The second way is through what you just described, through reinvesting dividends. So no matter where the dividends come from, as long as you reinvest those dividends, they will have a positive impact on the dividend snowball. Because that's going to allow you to get paid a larger dividend. You buy more shares, get paid a larger dividend next time, which will allow you to then go buy even more shares. And that's the process there. So that's number two. Number three is through dividend increases. So if an individual company or a dividend ETF raises their dividend, well, that also helps your snowball, helps your dividend snowball. And that's why we look at things like 5-year dividend growth rates. And that's why we take those things into account. And that's also why you have to look beyond just the dividend yield, because all of these things play a role in the growth of your dividend snowball and your passive income. So hopefully that answers your question right there. And man, guys, it's already 5:50. I can't believe it. Time flies. Real quick, shout out Matt Money. I just saw you're in here, man. Good to see you, and I hope you're having a good week. Thanks for tuning in. Also, Trey's here. What's up, Trey? Good to see you too. Doneska's here too. Doneska, very cool. Happy to see you. Let's keep going. I'm getting a little bit caught up here in the chat. I'm about 8 minutes behind. Also, I see Aaron here. What's up, Aaron? Let's see. This is a good question. So don't dividends go down with the interest rate drop? So dividends, it really depends. So dividend yields will fluctuate based on the dividend per share and the share price. Those are the two variables that can impact a stock's dividend yield. So let's say you have a $100 stock, right? And every single year that stock pays out $3 per share in dividends. So $3 per share in dividends on a $100 stock is going to leave you with a 3% dividend yield. But now let's say at some point in that year, the stock, let's just, for the sake of simplicity, let's say that it's still sitting at $100 per share, but they decide to raise the dividend from $3 to $3.50, so $3.50. Well, at that point, the dividend yield then becomes 3.5% instead of 3%. So it went up because the company raised the dividend. So hopefully, you get what I'm saying. But similarly, on looking at the other end of the equation, at the share price, if that goes up, like if it was to go to, if the dividend per share stayed the same, $3 in dividends per share per year, but the share price went up to, let's say, from $100 to $200, well, now your dividend yield was just cut in half and went from 3% down to 1.5%, because $3 into 200 is 1.5%. So those are the couple of things that can impact the dividend yield. Now, to answer the question, don't dividends go down with the interest rate drop? Potentially, typically, not typically, but in theory, interest rates can make lower interest rates can make stocks more attractive, and lower interest rates make it easier for stocks to appreciate in share price and in value. And if that were to occur, then yes, the dividend yield on the stocks whose share prices are going up, the dividend yield will go down. Does that kind of make sense? So, share prices, long story short, share prices and dividend yields have an inverse relationship. When share prices go up, dividend yields go down. When share prices go down, dividend yields go up. So if lower interest rates make share prices go up, then that will make dividend yields come down. Hopefully that makes sense. Sorry for if that was a weird way of explaining it, but anyway. This is a good question too. So assuming you're dollar cost averaging, do you ever think of getting a dividend payment, getting dividend payments to a certain number? Yeah, I mean it's something to look at. Let's see. Let me see if I can better answer that by just looking at where some things are at. Like, I like the idea of having every stock in my portfolio pay me $100 per year in dividends. So I like the idea of hitting those milestones, and I do think it's a cool idea to dollar cost average into positions until you hit that milestone. Like I can look at Visa and say I'm just going to buy Visa every single week until I'm making enough dividends to where it's bringing in $100 in dividends per year. I think that's one way to go about it, but and that works fine if you're dollar cost averaging. Um, but I'd prefer just to buy things based on kind of the share price action. I'd prefer to buy things just if the share price has been going down, then I'll put more emphasis on that than um, I will on getting the dividend payments to a certain number, if that makes sense. So, um, let's see. Okay. Um, Now I'm 3 minutes behind in the chat. Salvatore, did you ever think of automating a certain amount into a stock weekly, regardless of price, like a Johnson and Johnson? Um, I kind of thought about doing that with Visa, just until it became my largest position. But nah, I haven't really given that any serious consideration. I know Russ did that with Pepsi because he did and sorry, Russ, I'm speaking for you a little bit, but um, he had this goal to get Pepsi to 100 shares, and so he just bought Pepsi every single week until he hit those 100 shares, regardless of the price. And it worked out fine, right, Russ? Like it worked out just fine for you. And I'm sure if I was to do that with something like Johnson and Johnson, it would work out just fine as well. But and I will say too, times like this where I'm kind of not sure which companies I want to buy, or I'm not really sure where to put my money. The idea of doing something like this does become more tempting, because you feel like you need to be doing something, right? But yeah, no, I haven't really ever seriously considered doing something like you were talking about in the question there. This is a really tough question, actually. So do you think as a person starting out, a person should try to get to 100 shares of a company before, let me turn the light up a little more. Try to get to 100 shares of a company before they move to the second stock? That's so tough. Not necessarily. I think the short answer is not necessarily. Um, I think that, but I do like the idea of someone who's just starting out. I do like the idea of honing in on maybe one company at a time before moving on to the next one. So, and the inverse of that type of action would be to just pile into a ton of different stocks or a handful of different stocks all at once. And as someone who's just starting out, I don't think that would be the right way to go about it. I'm trying to like inverse it here, or yeah, trying to inverse the question here. So I don't think it's a good idea for a brand new investor to go all, not go all in, to pile into a lot of different individual companies. I think it makes more sense to start out just with like an ETF or two ETFs, build that as the foundation of your portfolio, and then possibly expand to individual stocks from there. And I think that would be the probably the most prudent way to go about it. And let's say that you're someone who's doing that. You have started with ETFs. You're building those up. You're in a good routine and have developed a good habit of dollar cost averaging into ETFs, but you're ready to expand beyond that and try your hand at individual stocks. I think that's totally fine. And in that instance, I do think it makes sense to just hone in on maybe one at a time. And I think you can get away with doing that because you already have the ETFs as the foundation here. So diversification is not as much of a concern for you because you're already well diversified with the ETFs. So I do think it makes sense to focus in on one individual stock and maybe build it out one at a time from there. And that doesn't mean necessarily getting to 100 shares. That I'm more so am saying that you should research just one stock at a time. Find one, just hone in on one until you've found one that you have determined is a good investment based on your research. Use that one as kind of like the practice, the test dummy too for your research, and starting to establish your own process. Get that one under your belt, then start looking for the next one. And, maybe with the next one, maybe you've researched a second or a third or a fourth or a fifth stock, and maybe you've determined they're good investments, but they're not the right time. Then that's okay. You don't have to buy them immediately. It's good to build a stockpile of stocks, a stockpile of stocks that you think are good investments, but it's not always the right time to buy them. Like Rollins, I'll use that as an example. I'm sure that I want to buy Rollins, but it's not the right time. And then I've got some other stocks that I'm watching that, I'm still kind of chewing on that. I'm pretty certain some of them I'm pretty certain are good investments, but maybe for some reason or another, I just haven't pulled the trigger on them. But anyway, hopefully that answers your question. Long story short, tying this all together, you don't necessarily have to get to 100 shares before you move on to the next stock, but I do think it makes sense to focus your energy on one at a time. I'll leave it there. Okay, guys, and we are just coming up to the top of the hour. Let me see. Let me just get caught up here. See what else we got in the chat. Yeah, this is actually a really good question here. And this has kind of been my thought and my MO these last few weeks. Do you feel like when the market has a huge couple of days and weeks in the green, you'd rather hold cash at the moment so you can spend it on stocks if they have a red day like today? Yeah, that's in effect, that's really what I've been doing. I mean, there was a few weeks in August, 2 or 3, where I didn't buy anything. I still contributed funds to the portfolio, but I just let it sit there. I eventually used that money to buy some Visa. But that's kind of what I'm doing this week too. I didn't invest anything. I made my contributions. I received some dividends, but I did not use that to buy any stocks yet. Maybe next week I'll have something that I'll want to pull the trigger on. But yeah, I'm kind of just sitting back right now, and at least for this week, I'm just kind of sitting back and just seeing where things end up. Like I said, like I've said a couple times throughout this stream, I see some potential with a couple different stocks, and I see, like Chevron's heading in a good direction, but still I'm just kind of like watching things and seeing where it plays out, seeing how it plays out. But yeah, there's some things that I'm watching right now, and it's in those instances, if you really just can't think of something that you want to buy, then there's nothing wrong with stacking some cash. And I even think I could probably do a better job of doing that. I tend to keep a good amount of cash in like my checking account and a high yield savings account. But as far as cash, like ready to go now in the brokerage account, I've not done a good job of building that up. And I think that's something that I could be better at doing. And I just really haven't figured out a good process, a good system for that yet. Because whenever there's like I'm putting $100 a week into my taxable account, and I'm like, okay, I guess I could just invest half of that and save half of that, invest 50 a week, save 50 a week. But I don't know. It's just, I have a harder time putting that into action. The idea is nice, and I think it's a good idea, but I have such a hard time not investing cash when I have it. Okay, this is a great question. Carlos, man, you got me with this one. I'm going to screenshot this one too, and I think this would be good to write about and put in a future video. So, and real quick too, I appreciate all the questions. I'm so apologize if I skip over some of your questions. I hope you guys know it's nothing personal. I scan. I'm kind of scanning the chat, and some pop out to me and whatnot. But anyway, regardless, I really appreciate the questions. I appreciate you guys being so active in the chat, and because that's really what keeps this going, and what makes this fun is being able to bounce off you guys. But anyway, Carlos, what would you say should be the first two goals to accomplish for new investors in their first year? So, oh man, I've never thought about this before, but this is a fun question. So one goal that I think, and I'm just thinking off the top of my head, if I think about it longer, I'll probably come up with some other things. But um, anyway, just off the top here, one of the goals that I think a new investor should accomplish. Oh, this is actually a good one. I actually have two pretty solid ones. One's very basic, but one is just to establish an unbreakably consistent habit in your first year. If you can do that, if you can start investing and make the decision to invest from that point on every single week or every single month. I don't care if it's $5 a week or however much it is. I think a really good goal, no matter the amount, is to look back on that first year and say that you were consistent the entire way. I didn't skip a week of investing. I didn't skip a month of contributing, whatever the time period is or the frequency is. I think one of your first goals should be to get in that consistent habit. I think if you can at least do that, that's the hardest part. The hardest part is starting, and then once you're going, is just taking it step by step. So I think if you can establish that routine in that first year, that's a great goal to shoot for and not skip a beat. The second thing is this. Okay. So the second thing, especially this more so applies to investors who want to research individual companies and invest in individual companies. The second goal, this is a non-negotiable, no matter whether it happens in the first year or whenever. This is a non-negotiable for anyone who wants to invest in individual companies. You need to start learning how to read financial statements. So I think that's another goal that that new investors should take upon themselves, or should work towards, to learn how to read financial statements. This book right here, let me see, the Warren Buffett and the Interpretation of Financial Statements. This is a great book. Let me do this so it's easier to see. Right here. This is the book you want. I think every new investor should get a copy of this book, especially if you do want to invest in individual companies. This is going to teach you so much. And the goal, I think, should be just to, at least go through it once. Go through it once and take notes. That's something that I probably should do. I've flipped through this book now probably 2 or 3 times. I try and read a little bit in it every day just to keep all the information fresh. And it's such an easy read. Like each chapter is only like a page or a couple pages, but it takes you line item by line item through all the financial statements, the income statement, the balance sheet, the cash flow statement. It teaches you everything, teaches you what, Warren might look for himself. But one thing I would like to do in time is develop some sort of screener or some sort of checklist based on this book for what Buffett looks for in a stock based on the various, financial statement findings. But I think that's goal number 2, is learn how to read financial statements, get this book. It's going to be a really good resource. But yeah, two goals right there. I think those should be your first 2 goals. Get consistent, learn how to read financial statements. I think that's just being able to do those things is going to make your life a lot easier as an investor. So, and will help you, develop a lot of confidence in what you're doing as well. So, yeah, this is a good question. Any chance you may put Google on your watch list? I had it on my watch list briefly, like when it first started paying a dividend. I put it on there, and I think it's great, but I'm investing into the S&P 500 every single week, and that already, Google's already one of the top positions there. So I don't really feel the need to own Google outside of that, at least for now. And I feel that way with about a lot of like tech stocks, because I don't know, I just get a lot of exposure to that already through the S&P that I'm already buying into every week. So, a lot of the big tech companies in there, I just don't feel the need to own individually for that reason. So anyway, Anyway, Shamir, another ad, LOL. Dude, I've seen every time an ad pops up, I see a comment from you mentioning the ad. And it's just a way of life. It's just they exist, This stream is free. The ad is the few seconds you have to sit through the ad is it's the only form of payment that you'll make on this live stream. So, and it kind of is what it is. So I mean, I apologize if the ads bother any of you guys, but I think it's a small price to pay personally. So, and you know what? I set them up to only run every 18 minutes on average. That's only 3 ads for an hour plus live stream. I really don't think that's too bad at all. Some of you guys might get them, some of you may not. And Shamir, maybe you're getting everyone else's ads, but anyway. Oh yeah, Donnie's cracking out a book. Yep, exactly. You guys know the rules. Okay, guys, I gotta go soon, but this is a good question. You guys know what buttons to push. You really do. You suggest any book for help me build a get portfolio. Okay. Basically, what Champa's asking is a book to help build a good portfolio. I think this one's really good. Warren Buffett and the Interpretation of Financial Statements. I also, where is it? Where is it? One sec, guys. Right here. I think this book is a really solid read as well. This is Investing for Growth by Terry Smith. I think this is a really, really important read for investors as well. It's basically just an anthology of all of Terry Smith's writings. And Terry Smith is the founder of a company called Fundsmith, excuse me. And he's been referred to as the British Warren Buffett. I will say, the second half of the book gets pretty repetitive, but you'll learn a lot in this book. The first half, you'll learn a lot, but then you'll hear it repeated throughout the rest of the book. So, oh yeah, Jim, I saw that this just came out. What's this book about? Because I'm curious to know, because I'd love to check it out. I like Josh Brown, but yeah, I'm curious to know. Yeah, talking about RM3, you're talking about doing that same thing. Well, yeah, maybe at some point. Next time I go through the book, I'm gonna take more notes on it and start getting a checklist going. Shamir, I'm reading McMillions. Oh, interesting. The book about the Monopoly game fraud. Oh, interesting. I remember seeing a oh gosh, was it on YouTube or was it on, maybe it was on HBO? And McMillions. It was called McMillions. It was the documentary. So maybe it's probably based on the book, but same name, that documentary McMillions. I think it was on HBO a few years back, but that was it was pretty interesting. Yeah. Russ said Terry Smith's strategy is to buy a great company and then do nothing. That's pretty much it. I mean, that's what I like about this book too. He just breaks it down so simple. Buy good companies, don't overpay, do nothing. And his valuation process is super simple too. He just looks at the free cash flow yield. In a nutshell, he just looks at the free cash flow yield and determines that, basically looks for a free cash flow yield that's at least 1% above the expected rate of inflation. At least in the book, according to the book, or his writing in the book, that's what he does. Maybe it's a bit more complex than that, but I don't know. Based on this, his whole thing is like, yeah, if the free cash flow yield is just 1 percentage point above the expected rate of inflation, then that should be a good enough price. So, or a good enough valuation there. Adam's reading a Random Walk Down Wall Street. Yeah, I know it's that one's supposed to be a classic too. I don't have that one. So let me show you guys what I'm rocking with real quick. So, okay, we'll do this and then we'll wrap it up here. Oh, okay, Shamir. So the book came out after the documentary. Yeah, interesting. So guys, right now I'm reading this is a really good book too so far, Thinking in Bets by Annie Duke. It basically talks about decision making and how we can better separate the outcome of certain decisions from the quality of decisions themselves. Like, for example, when it comes to any outcome, an outcome happens in part based on the decision you made. But also luck can play a role in outcomes and how they transpire. So a lot of the book talks about how to differentiate between between whether, let me restart that sentence. The book talks about how to differentiate between luck and skill and what role they play in the outcomes of your decisions. And it applies to investing and, obviously poker, because she was a poker champion. So that's the main context, but there's other stories as well. But yeah, so far it's been really interesting. After I finish this, I'm about halfway through this book. I've got 3 more on deck. I have What I Learned About Investing from Darwin by Pulak Prasad. I know Russ read this one and liked it a lot. I'm excited to get into this. I have Fooled by Randomness, Nassim Taleb. Very excited to get into this one. And then I have Investing, the Last Liberal Art by Robert G. Hagstrom. And I will be taking notes on all of these, putting them in my Investor's Almanac, and sharing them with all of the future members of the investment club, which should be going live here in the next few weeks, maybe the next month. But anyway, that's what I got as far as books. And then I think after I get through these few books, guys, I'm going to kind of take a break from reading just the general like investing books. And I think I'd rather transition into a different approach when it comes to the books that I choose to read. Like instead of reading about, like, I feel like I've read a lot of these just kind of investing based books, and psychology of investing books. I feel like I'm ready to move on to other things. Like I'd like to spend time reading about different industries in different businesses and try and better understand the nuance of certain industries. Like for example, I think I'd like to maybe take a deep dive into the pharmaceutical industry after I finish these books. And I have a few books that I added to my reading list that have to deal with pharmaceutical companies, how to look at them, maybe some historical events regarding pharmaceuticals. Anyway, stuff like that. But I'd really like to do a deep dive on that industry and learn more about it so I can apply that to investing. And then I want to do that same thing with other industries. Like me, I'd like to do a deep dive on the energy sector, or maybe get into books on like AI and the future of tech or something like that, just to better understand the nuance of certain industries. And I think that'll really help investing. Because what I'm kind of finding after reading so many books like Thinking in Bets or Thinking Fast and Slow, or probably Fooled by Randomness. I felt this way with Naval Ravikant's Almanac. I read that one right before this Thinking in Bets book. You start to hear a lot of similar things or a lot of the same things, which is good. It's good to have that familiarity. But because of that, because I'm noticing that more and more, I kind of feel like I need to move on to some other things, some other types of books. So I'm starting to feel that pull. But anyway, that was kind of a unnecessary tangent. But anyway, that's pretty much where we're at, guys. Elijah, when's the next video coming out? It will be coming out on Sunday, bright and early, my friend. I will be shooting and editing it tomorrow. And that's pretty much it. What's your favorite cremation / cemetery stock? I don't know, man. I'm not familiar with any of those. I think you were looking into them at some point, some of those funeral homes, from what I remember. Or maybe I'm thinking of Monish Pabrai. Maybe he was looking into those at one point. I often get Russ and Monish Pabrai confused. So many similarities between the two. Anyway, Jim, got random walk on PDF. I'll email it to you. Thank you. That'd be cool. But anyway, guys, we're about 15 minutes past the hour. I think this is a good time to wrap it up. I smell dinner. We're having some chicken tonight. Probably some fajitas, chicken fajitas. No tortilla, though. Just peppers and chicken and cheese. But anyway, this is where we're going to wrap it up. But with that, guys, excuse me. With that, thank you so much for hanging out with me this last 86 minutes or 76 minutes, excuse me. Thank you guys so much for hanging out with me. Another really fun stream as per usual. And yeah, I hope you guys have a great weekend. Definitely tune into Sunday's video. It's going to be hopefully a good one. And that's all I got for you guys. Keep up the good work, you guys. Hopefully we got some good things coming our way next week. And that's it. I will see you guys in the next one. You guys all have a fantastic weekend and stay out of trouble, please. I'll talk to you guys later.